Hello, everyone. Welcome to Serrala's Finance Conference online conference. Appreciate everyone being here. This session today is the Insight Talk, and we're going to discuss building your treasury transformation. Specifically, we're going to be focusing on market trends related to improving cash and liquidity at organizations around the world. And we are fortunate to have with us our esteemed guest, Kelvin Eng. Kelvin is a principal and director in the client advisory group at Citibank. He's been working in the area of finance and treasury for over 20 years on both the banking side and the operational executional side as a practitioner, and has been at Citibank for about 7 years, focused on helping clients to build market-leading treasury solutions. So we're very fortunate to have him. Welcome, Kelvin, to our finance conference.
Thank you, Peter. I'm glad to be here, and thanks for inviting me to this conference.
Pleasure. So, with Kelvin and I, we've done a couple of webinars together. So personally, I greatly appreciate you participating, Kelvin. We look forward to getting insights from you today. So I wanted to kick this off. You have been listening to the keynote speaker presentation that we had prior to the session, and there was some mention about some interesting tidbits of information in the surveys that were done by both PwC and by AFP. And one of those that struck me that I think is a good kicking off point here is that 65% of the respondents in the PwC survey had talked about being focused on rationalization of their bank accounts as a means to increasing their control, their visibility, manageability over their cash and liquidity. And so I want to just put that over to you and see what are your thoughts on that, and what kind of things are you seeing in the marketplace in this area related to that cash rationalization and related topics.
Yeah, absolutely, Peter. I think this is a great topic to start off with. Bank rationalization, bank account rationalization has been an ongoing process in recent years. Companies over time, especially those that have gone through multiple M&As, mergers, acquisitions, what they found is that they picked up a lot of banks and additional bank accounts along the way. And so this is really part and parcel of the process over time, whereby they want to rationalize not just the bank accounts in terms of having too many bank accounts, so it's difficult to manage. There's controls issues and not knowing which banks is out there, and it could be local banks where the headquarters treasury people don't even know who the relationship people are. At the same time, it's also rationalizing the banks as well. Now, part of this has to go towards the key issue on data management. Data management is key to a lot of treasuries today in terms of how they want to manage and run the treasury. So the big deal about treasury today is about data consumption. How banks pass the information to the ERP systems or the treasury management systems. Now imagine this: if you as a company have 40, 50 different bank relationships, imagine how you're going to deal with all 40 or 50 of them to pass you the information that you're looking for in order to manage your treasury process, in order to come up with your cash forecast, in order to basically look at your cash balances, your cash visibility, and what have you. Now, this is going to be an uphill task. So in order to make sure that these are well managed, controlled, so companies basically embark on a path today to try to rationalize this, and indeed they are looking to size down the number of banks, to reduce the number of bank accounts, so that they right-size these two aspects as far as the treasury operations are concerned.
Terrific. And so when you look at that and think about the rationalizing, what are you also seeing in the areas of cash pooling, about realigning or improving those structures, leveraging new products from the bank to be able to increase efficiency, manageability, and like you said, about the ability to access the data and information to give them that better control and insight to their liquidity and their cash positioning?
Yeah, I mean, cash is king. Cash is a corporate asset. These are mantras that have not changed. since the days that I started in Treasury, it has been like this, and still it remains to be the case. And so companies are often looking to consolidate the cash, to centralize the cash, to pool the cash in structures that are more and more efficient. And again, the way that companies like to do this today is to basically look at what's best in class. Indeed, as you rightly pointed out, Peter, different banks basically have come up with innovative products over time. There are not only just the traditional, what we call the TBA or the ZBA structures, as some of us know. These are the target balancing accounts or the zero balance accounts. But increasingly, banks are also having or rolling out products such as virtual accounts, cross-currency sweeps. So all these different products out there basically helps companies in terms of rationalizing their cash, centralizing their cash, and therefore, it helps them in terms of being able to consolidate the number of banks that help them in terms of their pooling structures, and it helps in terms of the data management as well. So it's all interlinked. When you think about bank account rationalization, bank rationalization, cash pooling, these are all intertwined themes that basically companies embark today to be more efficient and effective in treasury management.
And then I know in some of our previous conversations, you've talked about and emphasized some challenges that clients have had as they do that in their back-end systems, their ability to account for, to track, to manage intercompany loans, to recognize those positions efficiently and effectively, especially with the physical cash pooling as opposed to notional cash pooling. What kinds of things are you seeing there? What challenges are you seeing from clients experiencing, and how are you seeing them address those things?
Yeah, I think this is always a very interesting discussion. The topic of physical cash concentration or physical pooling versus notional pool. From what I've seen, some companies avoid intercompany loans on purpose. Okay, so by design, they do not want to manage intercompany loans. And so because of this, and also for tax reasons as well, some of them perhaps are not able to go through the tax hurdles that they may have with their internal tax team, tend to gravitate towards notional pool. Unfortunately, notional pool, at the end of the day, it actually lacks tax transparency at the same time. Why? In the sense that a notional pool is less transparent in terms of which entity is lending which entity. It's basically any bank account in the notional pool that goes short. The question is that who is it borrowing from? So this often becomes an issue, and then increasingly, whether it's Basel III or whether it is other regulators, the regulations are catching up. And basically, it would basically lead to potentially higher costs for maintaining structures like notional pool, which may render it not practical to adopt or operate in the future. Now, going over to intercompany loans as well as accounting, suffice to say that physical cash movement, in terms of the movement of cash, you have to book intercompany transactions, you have to book your intercompany loans, and accounting has to be on top of things. But think about it. This is all about automation. Nobody's saying that you have to manually book all of these things. And again, back to the data issue. When I talk about companies are increasingly looking to consume data in a big way, in an automated way, every single sweep has to come from your bank. It should come in the form of an electronic bank statement that feeds into either your ERP or your TMS, and your accounting engine, once it's set up by your accountants, will pick it up and it will automatically book the intercompany transactions. So these processes should be automated as much as possible, and so therefore picking the right banking partner, picking the right product type for your cash management or your liquidity structure is absolutely important. So what I've seen out there in terms of companies looking to review their liquidity structure, they are going through this these issues. They're thinking through them. But it's interesting that, Peter, that you brought it up, and I'm sure that there's definitely a lot more discussions to come. Some companies may disagree, or some may agree with what I say. And really, it all depends on the way that the tax partners internally within the company, how they actually look upon the cash pooling structures.
Yeah, I think you touched a couple of critical points there. The one regarding notional versus physical pooling has been a long-standing discussion. And I think what we see from clients is definitely those clients that are in a position with technology to be able to capture, track, and manage effectively those movements, physical movements, then they move towards physical movements. As you said, the lack of transparency in the notional pooling and the questions about who's borrowing from whom make things much more challenging. Also, we were just recently dealing with a client that was having issues with determination of truly how the calculations were done by the bank when they moved, whether it was a positive or negative balance, and how that was being allocated amongst the participants, which further made that process opaque. And so we see that with technology, using SAP technology, Serrala technology, using technology that can automatically read the electronic bank statements, incorporate those flows based on tags in the transactions, specific text in the transactions, allocate them appropriately, can create an effective solution that allows them to move to a model that gives them much more transparency, control, the ability to audit it, the ability to support it if they have a controlling entity come down and try and review to determine they have arm's length relationships, right? That's a big challenge that companies are facing, is to be able to document and prove that they are keeping an arm's length relationship, so they're not trying to skirt local taxation, local regulation, etc. Excuse me.
It's a good point. If I may add, Peter, please. I think the point that you made about systems and technology is absolutely true. But I would also add that basically for companies which, let's say they have not really come to upgrading their system, and they are looking to modernize their liquidity structure, there are also some banks like Citi, for example, which is able to provide interest reallocation too. So if a company or a client tells us, hey, this is the interest rate that we want to charge across in the bank. Well, LIBOR is going through a sunset right now, so I will not use LIBOR as a reference rate. Let's say SOFR plus 50 bips, whatever it might be, right? And so by giving that particular reference rate, we are able to basically calculate and even book the interest. And then basically once all that is done, that file that is sent back to the client's ERP or the TMS will pick up the same exact transaction that has been booked. So make no mistake, there are a few ways to basically deal with this as clients struggle with the thinking that there's accounting complexity, there's so much intercompany transactions to be booked day in, day out. If it's a daily sweeps, lots of legal entities, lots of transactions moving back and forth. There are ways to basically conquer this through technology, but that is the way to go. Nobody should be doing this via spreadsheets, trying to book things manually.
For sure.
Although
high risk,
that can be done.
High intensity manual engagement and high risk. But I think you made a good point there about there's a spectrum of need. Different clients, different requirements, different objectives, different staffing levels, different levels of technology. Obviously, no one size fits all. And there are a lot of great products and solutions and variations of solutions with mixing and matching technology, banking tools, relationships, et cetera, and people and processes to optimize your overall solution. You mentioned one other thing. You mentioned about VAM, virtual account management. This is a proliferating part of what we see in the marketplace, companies taking advantage of new products by banks. Can you talk a little bit about that? What are you seeing companies utilizing VAM for? How do you see them engaging that? And what kind of success are companies having utilizing those new solutions?
Absolutely. I'm happy to expand a little bit on virtual accounts. I think virtual accounts, in basic terms, as the term really means, is not a physical account, But virtual account basically goes under a single physical bank account. So underneath the physical bank account is a whole bunch of virtual accounts that can be tagged to the physical bank account. Now, in terms of how it can be used, there are two main ways that companies can actually use a virtual account. One way is to basically use it as a single entity model. What does it mean to be a single entity model? So some companies basically have bank accounts for AP, AR, for payroll, for this and that. And so it's not uncommon to find some companies basically end up with 7, 8, 10 bank accounts per legal entity because they have to separate all these different payments, collections, payroll into separate bank accounts for reconciliation purpose. Perhaps their back office, the shared service center people are covered in such a way that everything has to be separated in this way. Now, think of it as basically the virtual accounts will replace this physical bank accounts. So in a way, having just one physical bank account for that legal entity, and then underneath it, they're free to go with any number of virtual accounts underneath it, whether it's for AP, AR, payment by, for a single supplier, collection from a single customer, and basically you can basically separate it to any level that you want to. Now, the good thing about this structure, because it's single entity, it does not create intercompany transaction, and therefore it doesn't complicate the issues that we talked about earlier on. The other model that some companies get into is what I would call the multi-entity model. Now, the multi-entity model is tied very closely to in-house bank structures. Okay? Now, it's clear to me that more and more companies aspire to actually have in-house banks. Now, they aspire to have in-house banks not because it's just an aspiration or a goal. It's because the complexity of the company has grown. Companies have basically been growing both organically as well as through M&A. Their footprint globally is more diverse. The exposure to different countries and to different currencies has also grown over time. And so with this complexity, it makes sense to have an in-house bank. And so having an in-house bank, there are a couple of very advanced functionality attached to an in-house bank. Now, most companies start off with just a simple cash pooling structure, but that's not enough. Right? In order to have an in-house bank, to make it really efficient, to make it run and function very well as truly an in-house bank, and to reduce the number of external transactions, you basically layer in other things, for example, like payment on behalf of, or payment on behalf, or collections on behalf of, or receivables on behalf of, hobo-robo model. One way to basically leverage or to achieve hobo-robo model is using the virtual account. The virtual accounts, basically what it does, if you set up across multiple entities, it very simply means that the physical bank account sits at the in-house bank level, and everything underneath it, once the in-house bank pays or collects on behalf of the subsidiaries and affiliates, it basically replicates a true in-house bank model. So this is another way to basically use virtual accounts, and it's a very powerful tool because you don't have to centralize cash. You don't have to do cash pooling anymore. Why? Because the cash is already at the physical bank account. All the virtual accounts really does is that it's really separate reporting. It helps you in terms of segregating by the various legal entities in terms of accounting purposes so that you know where the funds are actually supposed to book against, which AP is supposed to book against, which AR is supposed to knock off against. And so those are the details that you're supposed to get from the banks when you get into a virtual account management arrangement with banks.
Yeah, so I would say over the last half a decade to a decade with the movement in this direction, one of the challenging areas was always receipts management. So every individual company had its own receipts management account because it's, first of all, management of incoming receivables is already challenging. What is that payment for? Who does it get allocated to? What specific invoices is it intended to clear? So given the complexity around receivables management in general, it always made sense from a complexity perspective to keep them segregated by company. With the advent of the virtual accounts and some advanced technology like Serrala's Auto Bank, which gives you capabilities along these lines, but the bank product of virtual accounts allows you to segregate at the very least based on the affiliate that you are applying the funds to. So the customer is automatically sending to a virtual account, which is essentially tagging that transaction, identifying specifically which company it should go to. So you have the ability now to conveniently and effectively consolidate receivables accounts, rationalize your bank accounts for on the receivable side, get them consolidated, and effectively apply that cash, at least to the appropriate entity. But you had also mentioned about at the level of the customer, that these virtual accounts can even be at a more granular level than just the affiliate that's receiving the funds or the funds are supposed to be applied to. We had a great example of this, a large company that has a large amount of receivables from a variety of customers. Some of those customers are very problematic, the way they deliver the information. So segregating them out, not just by the entity that's participating in the in-house bank, but at the customer level allows at least the information to get to the right subledger customer account for clearing. It may still be a challenge to find the right invoices, but at least it gets allocated to the right entity and then to the right customer. So we're definitely seeing a lot of advantages to clients in mixing that and utilizing that technology, those new products, advanced solutions with an in-house banking structure. When it's designed in an appropriate manner, you really can optimize, one, your bank account structure, two, your processes associated with receipts on behalf and payments on behalf as well, for sure. So you had also mentioned about the POBO side and leveraging VAM accounts to be able to effectively consolidate your POBO processes. One of the things that we're seeing is the ability to consolidate, one, the transactions, two, to aggregate payments across vendors, across their vendors and across their participants in their in-house bank. On those POBO structures, are you seeing expansive demand of that on the VAM side of that, and leveraging those tools as well, those models?
I would say it's picking up. One of the, and again, POBO is not something that is for everybody. And I want to pick up the point that you made earlier on, Peter. No one size that fits all. If it is that easy to implement POBO, I guarantee you every company will want to implement POBO and Robo as well. But the truth of the matter is that, based on our research at Citi, it's only about 10% of companies out there that manage to achieve Robo, and another 20 to 25% of companies out there that actually eventually implement some sort of POBO model. So it's not a big chunk of companies that can achieve this. However, what I feel is that the virtual account structures or the virtual account product that banks provide will actually help to enable this because it lessens the pain. So in Citi's example, what we can do is basically, even at the virtual account level, part of the issue in terms of implementing a POBO, for example, is that if the payment appears to come from another company to the supplier, right, from the perspective of supplier, come from another company, from another affiliate or another subsidiary, that is different from the name that it actually invoices, that becomes a problem. But the virtual account solution that we have is it enables the companies to actually change the name of the account as if it is coming from that account that is making the payment, even though physically the funds is coming from the in-house bank or from another legal entity. So that actually helps a lot in terms of alleviating these kind of issues. In the past, those issues have basically stayed around, and there wasn't really a workaround solution to that other than you sending a letter to the supplier saying that, hey, my payments moving forward will actually be paid from this legal entity. Please recognize it as good for payment, take it and don't reject it, right? So these are some of the advances in terms of the products, and it actually helps a lot in terms of making this a reality. Now, I just want to basically point out that to your question, is there more interest coming in from companies that I've seen? Answer is yes. They're definitely asking about it. They're definitely inquiring about it. They definitely want to learn more about it, to see what other companies are doing, right? So the interest is definitely there. Now, whether they get to implement it or not depends on whether they are able to get through the complexities. And some of these complexities are created internally. It's not really complexities that we would see as being there, but the companies are not able to get around it.
Yeah. So looking at keeping an eye on time, I wanted to just hit on one other topic. The topic of payment methods, means of executing payments. There's been a huge shift here, like we talked about with products for VAM. There are lots of new products, new payment media, payment methods, means of delivering and settling with your counterparties, with your own internal entities. What are you seeing in movements? You look at old payment methods like check, which is not even used broadly around the world, but there are still some countries, United States for sure, that heavily rely on checks. What are you seeing in movements away from these types of products to more efficient models that give greater control, greater visibility, again, over liquidity and cash management?
So that's a great question. I think companies definitely recognize that checks needs to go away, that basically they have to go on electronic methods as much as possible. I've seen this come through some recent RFPs, by the way. So, I mean, these are companies that sell B2C. They sell to customers. And so, you can be assured that when it comes to customers, there's cash involved, there's checks involved. Not everybody wants or likes to pay using a credit card. So I think these are real life examples I'm seeing that some of these companies are increasingly making an effort to eradicate checks as well as cash. Now, those of us who are old enough will remember good old days. There's this thing called a petty cash account. I mean, these things exist long enough, but I think to the millennials, they must be wondering, what is this that I'm talking about? But those of you who remember the petty cash account, those were a pain to deal with in Treasury because you don't want to deal with that, and you absolutely want to get rid of the petty cash account. Right? Today, you don't see so much of that today because, companies have moved on. Any kind of expenses for a party, for pantry expenses and things like that, all that is already contracted and all done through the normal payment methods that we see. Now, in terms of where the market is shifting in terms of payments, APIs are increasingly coming up. The demand for instant payments are also slowly coming up. Now, as basically price pressure pulls the cost of some of these products down, and increasing demand and increasing usage of these type of payments, basically what I'm also seeing is that companies are increasingly asking about it. Real-time payments, right? The ability to track payments on a real-time basis. Where is this payment going out to? Where is it at any one point in time? Now, of course, this is critical for major transactions, like if you're making M&A payments, you would absolutely want to do that, and basically to be able to track where the money is at any one point in time. But increasingly, there's also a lot of companies who don't want to sit on cash float anymore, right? So all the ACH, in terms of the cash float, keeping cash in your bank accounts for a few days while it's being deducted, companies want to deal with real time, so that you know that at any one point in time when you call up the cash position of your bank account, you know it is the actual balance at that point in time, and that there's nothing fuzzy going around, some things waiting to come in and some things waiting to go out. Real time is really what is going on. It's going to be the future. I think this will be a new thing for those of us who have been in Treasury. It's certainly an ongoing trend that I've seen.
Yeah, terrific. Thank you for that insight. There's a lot to come in that area for sure. We're definitely seeing movements in that direction, and having the right technology to be able to support those kinds of payments and track them, manage them, get the acknowledgments from the banks, and be able to keep those statuses updated is definitely critical to be able to facilitate that kind of payment and utilize it in a productive environment. I look forward to future conversations with you, Kelvin, to delve into that topic and many more in the future. Looking at the time, we're right up against our 30 minutes. I greatly appreciate you giving us your time and discussing what you're seeing in your experiences at the bank. We appreciate your participation. I would like to thank everyone who listened to us and participated in this conference. Appreciate your participation as well, and we hope that you stick around for upcoming additional sessions. Thank you. Have a great day.
Thank you for having me. Thank you.